Hey, what's going on, guys? Welcome back to my channel. This is Blood Phantom 81. Gonna mix it up for my usual stock market recap and update videos. Last time I asked you guys if you wanted to see a tax video because this year I'm actually going to be paying about $20,000 in taxes, which is definitely the most I've ever paid before. And it can be avoided by a very simple mistake. This is not clickbait at all. I really hope that you guys learn something from this or take away something from it. The reason why this is so annoying and frustrating is because number one, it was actually completely unnecessary, and number two is because that $20,000 was going to be a somewhat of a large portion for a down payment on a house. So I need to kind of rebuild that, 20K and then some. So yeah, so let's jump right into it. And first of all, thank you guys for voting. I know a few of you guys voted, so thank you guys, Ryan and Market Scraper, and Slow but Still Learning. I honestly relate to that YouTube channel name. So yeah, let's jump right into the video. All right, so I'll just read off the first few sentences from Investopedia's definition of the wash sale rule, and then I'll put it in my own words. So, the wash sale rule is an IRS regulation that prevents a taxpayer from taking a tax deduction for security sold in a wash sale. Now, what is a wash sale? The rule defines a wash sale as one that occurs when an individual sells or trades a security at a loss and within 30 days before or after the sale buys a substantially identical stock or security. Now, there is some gray area here with what the substantial identical stock or security actually means. There's actually a trick to get around that, which I'll share towards the end of the video, so stay tuned for that. But basically, it's a rule where you sell a stock at a loss and within 30 days you buy the same thing. What that means is actually, well, as far as the consequences go, is actually explained here in these key takeaways. So, the wash sale rule prevents taxpayers from deducting a capital loss on the sale against the capital gain. So, let me actually go through an example because I feel like this is kind of technical jargon. All right, so we're going to go through the example of buying stock XYZ. So on Monday, we buy stock XYZ at $100 per share. And then on Thursday, we get kind of scared because, it just completely crashed. It was like a penny stock that we got off of Reddit or something. And then on Thursday, we sell stock XYZ at $50 per share. Okay, cool. So technically, we are at a $50 per share loss, right? So let's just say we actually bought 10 shares of XYZ at $100 per share, and we sold 10 shares of stock XYZ at $50 per share. Okay, cool. Now to add some more information into this. So technically 10 shares at $100 a share, that's actually $1,000, right? So $1,000 was the total transaction cost. And since we sold it, then we're only going to get about $500 in return. So that's a loss of about $500, obviously. Now, let's say we change our minds. We say, why did I sell this thing? I actually believe it in the long term. I'm going to go ahead and repurchase XYZ. So we do just that. So then on Friday, we actually buy XYZ again. So we buy 10 shares of XYZ, but this time it's at $50 per share, and it costs $500 again. Now, even though these transactions are somewhat the same, right? By doing so, we can no longer consider this $500 loss as part of the total capital gain. So what happens is, let's say next Friday, what we do is we actually sell this. Let's say it actually does recover. So it goes back to $100 per share, and then we get $1,000 of a total cost, right? So let's just summarize exactly what happened here. So as far as a summary goes, so the first thing we did was we took a $500 loss. And then what happened is we made a $500 gain. However, even though this technically should be a total capital gain of about $0, this is actually not true because we can't consider this loss as part of the capital gain. So it's almost as if we made $500, even though we didn't. I did exactly this. And why did I do that? So just for some summary, obviously, if you guys don't really care about, my personal trading, you can go ahead and click off the video. But basically, the reason why I did this is because, so March 2020 was actually a pretty rough year for me financially, as well as other folks. I think I was actually unemployed for most of 2020 and maybe a few months. Yeah, 3 months out of 2019. Definitely a pretty rough year for me. And then, of course, the market decides to crash around that time. And yeah, things just got super complicated. Basically, I determined, okay, as the market was crashing, this was probably the maximum amount that I wanted to lose because I was basically living off my portfolio at the time. I was living in San Francisco, Bay Area, California. Well, not San Francisco, but the Bay Area, California, which is probably one of the most expensive cities to live in just in general, right? But if you're unemployed, it's stupid. So yeah, so then I set like a max amount. Okay, I'm willing to lose this much. And then that happened. But then I was like, I could definitely see the market bottoming pretty soon. So then I ended up rebuying what I sold, I think that following week or that same week. And then the market like had a V-shaped recovery. So I started to take profits as the market was recovering just because, yeah, I wasn't in a good place. So yeah, that ended up happening. And the reason why I say it's necessary is because I kind of knew that I would, be feeling this, but at the moment I wasn't really thinking about what would happen next year. I was just kind of like, how do I make the most out of this current situation? And so, yeah, so that's basically why I did what I did. I think in hindsight, obviously we're all geniuses in hindsight. I'm not saying that, I'm smart enough to have foreseen what was coming, because definitely not, right? But I do think that I should have, been a little bit more kind to future me, I would say. And that's actually something that I'm starting to do even today. So, to do things that future you would appreciate. So that is going to wrap up this video. Basically, the point is be very, very mindful of wash sales. The last sort of two tips I would give is that on the flip side, if if let's say all you did was take a $500 loss, right, and you never rebought it, then all you have is a $500 gain. So in total, you have a $500 loss. Then you can actually write this off against other profits or your taxes in general, your income in general. So you can write this off, which is actually really, really awesome, right? So if you have a company that you're not really feeling and you want to basically cut ties with it, then yeah, keep in mind there is some tax benefit to doing so. And the other thing I'll say is that so there was some gray area with you have to buy substantially identical. So let's just go ahead and talk about that gray area really quickly. So let's say you own some broad market index funds, such as VO or VTI. So technically the performance is very, very similar. In fact, it's almost identical, but these are actually different slices of the market. The VO is the S&P 500. VTI is basically the total stock market index fund. And you can use tax loss harvesting to your advantage using broad market index funds. So for example, if you own VOO and you lose, let's say 20% of your position, you can actually sell VOO at a 20% loss and then buy VTI. And then you'll use that 20% against your other capital gains, basically. And so that would work with broad market index funds. We can talk about tech funds as well. So like the NASDAQ, which is QQQ, versus VGT, which is the technology sector of the S&P 500. The same thing would apply. So these are technically different slices of the market. If you're down, let's say 30% on QQQ, you can sell QQQ and then buy VGT. And the loss that you got from QQQ can actually, it would count against your capital gains. And so, yeah, just a couple of tricks. Make sure you definitely do your research on whichever funds that you're going to be doing. Even the funds that I'm talking about right now, right? Because rules can change all the time. So before you do anything, just make sure you actually look it up. Make sure that's actually going to be the case of what you expect. But with that out of the way, yeah, I hope you guys learned some valuable tips, and I'll catch you guys in the next video.